All right, a little bit of a dip in futures after finally hitting all-time highs yesterday. Happy Friday. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, a softening stance. President Donald Trump says he'd rather not put tariffs on China. Futures fluctuating and the dollar drops. And we round out this earnings week with insight from the C-suite. The CEO of American Express tells Bloomberg that consumer confidence is up, and next hour, Verizon's CEO shares his outlook with us. And over in Europe, Novo Nordisk shares jump after an experimental shot delivered as much as 22% weight loss in an early stage trial. Eli Lilly shares down a little bit in response. All of that and more coming up. Let's take a look at where markets are trading. Like I said, 30 minutes until the bell rings on this Friday trading session. You can see we're dipping a little bit. We finally reached that record high yesterday. We had a big rally into the close. Now we're coming off the boil a little bit. The S&P 500 down about 0.1%. Similar story if you take a look at the NASDAQ 100, and not much to say about the bond market right now. We're above 460, hanging out at those levels, but at least for right at this moment, Sonali, yields are unchanged.
For this moment, let's see where next week takes us. Of course, a lot of relief with those comments from the president. But let's talk about the earnings story still, because we do have more news under the surface. Texas Instruments dropping after it gave a disappointing forecast, and sluggish chip demand really impacting them now, down about 4.7% pre-market. Boeing also down after another quarter of losses. Surprise preliminary results were reported this morning. The stock now down another 1% pre-market. Verizon now on the rise, 1.3% higher. We're going to speak to Verizon CEO Hans Vestberg next hour. An AI announcement there, but also some stronger numbers in really big walk up to earnings season that starts in full form really next week, right, Katie?
Yeah, it's going to be really interesting to see what corporate America delivers on the earnings front, what the Fed delivers on the macroeconomic front, because right now it seems like it's smooth sailing, of course, in the market. You take a look at what the S&P 500 has done so far this week. We mentioned that all-time high. The index up about 2% so far on a weekly basis. If that stands, Sonali, the S&P 500 is poised for the best start for a new president since Ronald Reagan was sworn into power in 1985. We've been talking about this Trump trade, the enthusiasm we saw after Election Day. It wavered a little bit, but now it's back in full force.
And it helps that you didn't see the brunt of the tariff strategy take force in the first week. It helps that yields have behaved, doesn't it? Mm-hmm. We're going to talk a lot more about this now with Jack Janasiewicz, who is the portfolio manager and lead portfolio strategist at Natixis Investment Manager Solutions. Like Katie said, it is Friday. And so you're watching earnings season underway. You have the market largely reacting to vibes, to what the president is saying in his first week in office. At what point does the earnings story also matter? Because you are seeing on a stock-by-stock basis some interesting reactions.
Sure. And I think, as you noted coming into this, it's the interest rate backdrop. That's a concern. It's been a tariff concern. We've got a little bit of softening on both fronts. And then it brings us right back to the earnings backdrop. And, aside from a few idiosyncratic stories there, I think, broadly speaking, the earnings game has been pretty supportive in here. And, it kicked off with the bank backdrop. They all basically came out and crushed it. And we're seeing, these bits and pieces of other areas of the market still coming in quite strong. Look at some of the retailers on the luxury side, right? Schmott, Burberry, they knocked it out as well. So I think in general, you're getting a pretty good undertone for earnings in here, and that's what matters.
So what does that mean for the setup going into next week? You have the big tech giants reporting. Does it mean that you lean in further to the mega cap trade, or does the broadening story make even more sense to you today?
I think you're going to get a little of both in here. When we sort of looked at what happened at the last week of the year, you had some de-risking going on. You had a sentiment reset. A lot of the surveys that we pay attention to certainly saw the bullish sentiment come off the boil. You had a little bit of selling that we saw from our ETF and mutual fund products that we're paying attention to. And if you look at some of the modeling we do with regard to the leverage players, they've actually degrossed as well. So you're coming in from a sentiment reset. And I think anything that you get with a positive backdrop in here probably still pushes the market higher. And I think it's a combination of a breadth widening out, and you're still going to get tech leadership as well in here. So I think a lot of things still can work in here.
Well, let's talk about what could upset the apple cart, because we've been in a Fed blackout period. Maybe that helps explain why we've seen some stability return to the bond market. That ends next week. We're getting into the heart of earnings season as well. And if the first 4 days of the Trump administration are any guide, there's plenty of more coming on the political side of things as well. How are you thinking about the different cross currents here?
Yeah, I think we have to really kind of look through a little bit with regard to that geopolitical volatility. Again, what's the underlying strength of the economy? It's going to be the earnings backdrop that's continuing to, I think, support the broader stock market here. You're going to get these headlines. You're going to get the Twitter bombs overnight. And it's just a question of, is this sort of going to be a little bit more bark than bite, so to speak? I think you can maybe take that with some of the things that we've seen on the tariff front, where you sort of expect the worst and hope for the best. And, we've had a little bit of that toned down. And I think that's just upside for the market in here. So you sort of have to look through some of the geopolitical noise and really focus on the underlying fundamentals here. The economy's still in good shape, and earnings are actually continuing to grind higher.
Yeah, now these Twitter bombs have turned into Truth Social bombs, which are then reposted on X bombs. But now we're just mincing words here, Jack. So, OK, so you're looking through a lot of the noise. You're focusing on the fundamentals. Talk, though, about some of the other forces outside of just the equity market. When you think about the bond market, as we've been saying, well-behaved this morning. This week, though, we've seen a little bit of a quiet climb at the long end. When does that start to become a problem? What levels are we talking about where you would start to get concerned?
Yeah, and that's probably the key here, because I think you can start to make all sorts of stories that can funnel its way back into, ultimately, that interest rate backdrop. And so, if you push closer to, I think, 5% on the 10-year yield, you're probably going to have the market rethink that backdrop in here. But, if you think about where we've priced out almost all of the rate cuts basically a couple of weeks back. So I think for the market to become incrementally more hawkish, you'd have to start talking about rate hikes. And I think that's a pretty big bar for the Fed to sort of get over. And so, as we sort of price out those rate cuts, you're talking about moving to rate hikes, probably big bar there. The market's probably at peak hawkishness. And so, when you start to pay attention to what's going on in the inflation data and look at that shelter figure, it continues to grind lower. That's a big component, of course, CPI. That's going to be a big headwind going forward for inflation resurging or reaccelerating in here. And as a result, I think it's going to be tough to see a market break higher in yields, but that's probably going to be the key risk going forward here. Higher yields, that 5% level.
5% level. So what's the tail risk here? Is this idea that you can get meaningfully higher than 5% in your calculus as you make decisions in the market right now?
There's a couple things to think about there. One, it probably has to really come down to reacceleration inflation, but you also have to consider the potential for the fiscal deficit, the bond vigilantes to come back in here and sort of take control of that bond market backdrop. So debt ceiling worries, fiscal deficit continuing to widen out. That's the other risk that you could see from that tail perspective, where you could see that 5-year breach and continuing to push higher.
All right, Jack, great setup. Enjoy your weekend when you get there. That is Jack Janasiewicz of Natixis Investment Manager Solution. Meanwhile, let's get specific here and talk single stocks, because pharma giant Novo Nordisk absolutely soaring right now after posting some results on an experimental shot, which could add to the company's weight loss offerings. You take a look at Eli Lilly here in the U.S., also down a little bit in response. Of course, we're talking about Novo's main rival here, and it's really a two-way race. Let's digest the data now with Sam Fazeli. He is Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. So, Sam, of course, when it comes to Novo, when it comes to Lilly, their pipelines right now are under the microscope. Novo needed some good news, and it seems like we got some.
Oh, God, yes, they needed some good news. I mean, that stock is off. It's almost halved. Of course, mathematically it hasn't. It's just less than, it's like 40-odd% down since the peak it hit back in the middle of last year, which is a big thing for a company that became the largest stock in the European space. And now, of course, it's given that back up to LVMH, I think. As I keep calling this, it's snake and ladders. I don't know if folks still play that game, or do they still have that board game, but you keep work hard to climb, and then bam, you're off again. And it's a competition between who's got the biggest weight loss. Is it 23%? Is it 22%? Does Lilly have it? At the end of the day, we all seem to be skirting around the 23, 24, 25% range. And it all comes down to tolerability. You lose the weight, but how do you feel? Unfortunately, Novo didn't give us that data, but this is definitely a positive for them today.
Sam, I want to pull up a chart over 1 year for Eli Lilly and Novo Nordisk because the gap has seriously widened. We're talking about a company, Novo Nordisk, that was the most valuable company in Europe. It has lost about a third of its value since the high. How did this happen?
Yeah, it was all about competition, data not being as good as they said it would be. And then, of course, Lilly missed a couple of quarters and everybody started worrying, oh my God, is that demand that we all expected, i.e. 100 million, whatever number of patients could be benefiting from these weight loss drugs, which is not my favorite way of calling them. They are much more broadly active than just weight loss. Nevertheless, that's what led to this, a little bit of uncertainty. And then Novo, of course, came and missed its own target in the last readout, which was CagriSema, if you remember, just before Christmas. They said we're going to get 25%. They ended up at about 23% in the best case assessment of that data set. So folks started worrying. And Lilly's got a lot more strings to its bow. So that's why you see that differential in performance.
Sam, we have to leave it there. We thank you so very much for your time. Of course, a big story of the morning. That is Sam Fazeli of Bloomberg Intelligence. Now, another big story of the morning. Want to bring you some breaking news. Mark Zuckerberg says Meta's CapEx this year is going to be $60 to $65 billion. The estimate was $51.3 billion. And you do see Meta shares reacting down pre-market about 1%. He said this in a Facebook post. He says this will be a defining year for artificial intelligence. He says that he believes that Meta AI will be the leading assistant to serve more than 1 billion people. He is pitching the prospects here, Katie, of Llama 4 to be a state-of-the-art model here. Of course, we know that he has a lot of differences in how he views the future of artificial intelligence compared with others.
Well, let's just restate those numbers because they are enormous. $60 to $65 billion. Again, the estimate, like you said, for $51 billion. It's interesting to see the stock fall. We know that Meta has come under a lot of scrutiny from shareholders for their spending. That was the story of 2022. We entered the year of efficiency. That has led to outperformance. But now, I don't know. It seems like the year of efficiency, a distant memory, and now they're spending big to get in the game.
Yeah, we can see that spending come back. They have also outperformed their rivals, so maybe they have a little room to get this done. We're going to talk more about that story and others. Stick with us. More markets ahead. This is Bloomberg.
All right, we also have our eyes on Boeing this morning, out with a surprise announcement ahead of their earnings next week. Last night, they said that they're suffering another quarter of fresh charges and losses. The results highlighting, of course, that long road ahead for the new CEO, Kelly Ortberg, as he tries to stabilize the U.S. aircraft manufacturer. Let's break it down now with Benedict Kammel. He leads Bloomberg's global aviation coverage. So we've kept our eyes so trained on that commercial airplanes unit. It seems like maybe we should have also been taking a look at what's going on with the defense business as well.
Yeah, that's right. There are absolutely multiple fires at Boeing. And as you said, the commercial business is what people have been focused on for a good reason. I mean, that's the business that suffered quite stunning losses last year. We had the strike. That was painful. And that all contributed to that really dismal fourth quarter. But then there was a big charge at the defense business, the mid-air refueling tanker, the new Air Force One presidential plane that's delayed. All those things contributing to these charges. And really, wherever you look at Boeing right now, there's a lot of costs, there's a lot of losses, and as I said, another dismal quarter for them.
However, is some of this bad news okay news if you consider that they're trying to bite the bullet a bit here with this pre-release?
Yeah, that's probably right. And they did the same thing last time. So last time they came out with those substantial job cuts. So they really sort of kitchen sinked it, as it were. This time, a little thinner on the details. So we really have to wait for Tuesday to get the full narrative. We'll hear from Kelly Ortberg, the CEO. We'll hear from him what he has to say about how he plans the road forward, how he plans to stabilize the business. That's really what people want to hear. How is he going to get out of these unprofitable contracts? How does the build rate build up over the next next year. They are really depressed right now in terms of the output of their commercial aircraft. So a lot of people want to sort of put that year behind them, the 2024 year, which everyone agrees was not a great year for Boeing, and really think about, okay, what is the road ahead for this company? How can they stabilize the business? How can they really get aircraft production back in order? How can they get out of these unprofitable defense contracts? So a lot of questions for Kelly Ortberg. He's sort of taken the sting out of it with that pre-announce, but there's still a lot of things to go over on Tuesday.
Yeah, absolutely. Will be a very interesting earnings call to tune into, to say the least. But give us a lay of the land when it comes to the competitive landscape. It feels like the only serious competitor for Boeing is Airbus, of course. How has Airbus been capitalizing on this moment this year and then some?
Well, if you look at 2024, Airbus delivered more than twice as many aircraft as Boeing did. So that gives you a sense of just how it has tilted towards Airbus. At the same time, Boeing might be in a difficult position right now, but they still have $500 billion of planes on order. So there's a huge backlog there of unfulfilled orders. So people are still optimistic that if they can get their act back together, they have a good chance of getting back into that duopoly. And as you said, there's really only two players in this market right now. It's Airbus and it's Boeing. Boeing needs to be careful that they don't slip and sort of become an also-ran. The Chinese are not standing still. They have a plane called the Comac 919. That's a plane that's not certified outside of China yet, but that's a matter of time. And at some point, the global industry will take a hard look at that particular product and might sway that way as well. So Boeing really has to defend its turf here, as I said, if they don't want to sort of slip.
Yeah, great point there on China. Don't take your eyes off that country either. Benny, have to leave it there. Our thanks, of course, to Bloomberg's Benedict Kamel. And meanwhile, we'd like to make a clarification. The other day, we got news that Stellantis will produce its new mid-size pickup in Illinois. It also announced investments in its Ohio and Indiana facilities. And to clarify, product decisions announced by Stellantis on January 22nd won't affect current production in Canada, and no jobs or manufacturing work in that country are being moved to the U.S. as a result. This is Bloomberg.
Now we want to bring you some more of that breaking news. Meta planning a major investment in artificial intelligence. In a Facebook post, CEO Mark Zuckerberg says the tech giant will invest up to $65 billion. $65 billion is $15 billion more than the estimate out there. The average estimate was about $51 billion. Mandeep Singh of Bloomberg Intelligence joins us now on that CapEx figure. You are seeing Meta shares reacting, but this was one of the better performers over the last 12 months in the Magnificent Seven. Can they afford it? Are they basically telling investors to be patient? We have bigger ambitions.
Well, what's transpired in the last 1 week, you know, with the Project Stargate, and even before that with Microsoft saying they are going to spend $80 billion in AI CapEx this year, is forcing the likes of Meta to raise their CapEx. I mean, I expect Google to do the same when they come out with their earnings. They'll probably raise the CapEx because when you look at the aggregate number from the 4 hyperscalers last year, they raised their CapEx by about 45 to 50%. So this year, consensus was like it's going to decelerate to 20 to 25%. Well, guess what? It's going back to 50%, which is what Meta has guided to now, and what Microsoft is doing. So I expect the other hyperscalers to follow.
Well, talk to us about the history of Meta spend here. We were talking a little bit about the year of efficiency and how that was really welcomed by investors. That's been over for a while, and now you see these big, aggressive CapEx numbers come out again. When it comes to the investor perspective, how important is it going to be where they spend the $65 billion?
Well, we know everyone wants to build the biggest compute cluster. I mean, Elon Musk built a 100,000 GPU cluster. Now everyone is talking about a 1 million GPU cluster. And look, the bigger cluster you have, it helps you with the scaling laws. At least that's the prevailing narrative. And everyone feels they want that NVIDIA allocation. Nobody wants to miss out on NVIDIA allocating a certain number of GPUs. So for that, you have to raise your CapEx.
I feel like it's hard not to make the mistake of reading too much into things. right now. The fact that he made this announcement on Facebook and not in an investor filing really strikes me, because many years ago that wouldn't have even really been allowed. It feels very Elon Musk to do that sort of thing. Is this a way to also show people that he's going to be communicating this way more often from now on?
I mean, look, investors care about, what the company plans to do in terms of monetization and their investments. And with Meta, the question remains, how are they going to monetize their Llama model? And if he wants to interact with, everyone through Facebook or X or Instagram, it doesn't really matter. But it comes down to Meta being that social media provider, not having a cloud business. How do they actually monetize all this investment? And it's going to be through their family of apps. But the big difference is Google and Microsoft have a cloud business where they can monetize all these investments. Meta does not, and he has to explain that.
All right, Mandeep, always great to speak with you. Appreciate you stopping by on this breaking news moment. Again, that news out from Meta, that CapEx spend is going to be higher than expected, up to $65 billion. The estimate had been for around $51 billion, so boosting up those levels to try to get ahead on AI. Meanwhile, let's take a quick check at futures here. Of course, we're minutes away from that opening bell. You can see we're pretty much unchanged on the day, Sonali, but it's been quite a week for the S&P 500, up about 2% as of yesterday's close. We finally hit those record highs. The Nasdaq 100 also pretty much unchanged. The color's green, but the numbers aren't too inspiring. The Russell 2000, a little bit more of direction here, down about 0.4%. And it's not even worth talking about the bond market, but it's going to be next week.
Sigh of relief. Got through the first week with very little volatility compared to what was expected. But of course, those small caps hitting a wall, I've got to say. I feel like you might have emotions. I have emotions.
Yeah, those little guys, I'm sure that they were cheering on President Donald Trump yesterday, calling for lower interest rates. I would love to be a fly on the wall in next week's policy meeting at the Federal Reserve. But in any case, we're 4 minutes away from that opening bell. Coming up next, we'll discuss the market moves with Sarah Ketterer of Causeway Capital Management. This is Bloomberg. All right, we are moments away from the start of trading on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. Of course, we're counting down to the end of the week. That has been huge for the S&P 500. The first full week of Donald Trump's administration. Of course, we've gotten a lot of news when it comes to immigration, when it comes to tariffs, when it comes to AI. You add it all together, and somehow the S&P 500 has found a way to rally by 2%. That is the best performance for the first week of a new president since 1985. That was, of course, the week that was heading into yesterday's close. You take a look at where we're trading as today kicks off. A bit of a breather. We got above 6,100 yesterday on the S&P 500. We hit a fresh record high. Some of that momentum is fading a little bit right now. The S&P 500, I'm going to go ahead and call that unchanged. You could round big tech up to 0.1% higher if you're feeling optimistic. The tech index in the green right now. I can't say the same for the small caps. As Sonali said, hitting a little bit of a wall when it comes to the Russell 2000, currently down by about 0.1%. We were down a little bit more when it comes to that pre-market trade. We'll see what happens between now and 4 p.m. Meanwhile, let's get to some of the individual movers, because Texas Instruments dropping after a disappointing earnings forecast, hurt by still sluggish chip demand and higher manufacturing costs. Shares currently off by about 5%, Sonali.
Yeah, more earnings this morning that we're keeping an eye on here. But first, watching Meta. We are watching after CEO Mark Zuckerberg says his company will invest between 60 and 65 billion in CapEx related to AI in 2025, which is well above the figure analysts had been projecting. You are seeing a rise in the shares now, up on more than 0.3%, half of 1% now. Interesting after the initial decline that we saw in the reaction. Also watching American Express, because the credit card company reported fourth quarter expenses that were higher, and you now see Amex down about 0.7%. A close eye on expenses. Interesting move in Amex, of course, which has been otherwise a darling. Let's take a look at Amex with Bloomberg Technology co-host Caroline Hyde, who spoke with the company's CEO earlier. And Caroline, so interesting here because the numbers themselves were good in terms of the top line, but to get those customers in the door, you have to spend more, don't you?
Yeah, you've got to market to them. You've got to offer them some nice little perks if you're going to be upgrading to a flashy new corporate or indeed consumer card. And they have been signing up yet more and more people when it comes to the gold cards that you also know well at Amex, but whether or not corporate spending is up. I think more broadly, this is a company that's coming bang in line with expectations. They're raising their dividend. They're seeing profits up about 12%. And they actually think this sort of growth is sustainable. Really optimistic, CEO Steve Squeri, about where we're going to see the future of 2025. This momentum that he saw in the fourth quarter, he thinks is likely going to stick. Consumer confidence is building. And what I think is interesting is also business confidence is building as well. Big businesses are spending more. Corporate card business have been more positive. And even the small businesses in particular have been better in the fourth quarter. He thinks that momentum with the regulatory changes, with the new administration, with inflation looking like it's coming down, is going to be there to stick.
And so we're talking about spending a lot this morning. We'll ask you specifically about Meta, but where is Amex spending right now when you think about where they're trying to get ahead?
Okay, nice flow into Meta because it's tech. They are investing in marketing and they want to ensure that you're being hit no matter where you see digitally advertising for Amex and thinking about getting a card. But you're also, and it's Millennial and Gen Z that are really picking up on these cards in particular. But then it's about the digital trends. It's the fact that they're having to get more talent. When he says they're spending on digital, what they're doing is they're spending on talent. He's getting more AI expertise in the door. We're having more people doing coding. He's using artificial intelligence, whether it's coming in to ensure whether they're preventing fraud or whether they're helping on customer service. But that does take talent. So they're having to up their spend and commitment to tech and talent more broadly.
You know, speaking of spend, going back to Meta, you are seeing this announcement come ahead of big tech earnings next week. How does it really set the bar here, the expectation that you could expect more spending, and not just by a little bit, by a lot?
I love that you bring that up, because why not save this for next week, for the earnings? He kind of wants to catch a bit of a moment on Threads and Facebook instead of a regulatory news service instead. And he really is dialing into this fact that we've heard from Microsoft that they're going to be spending more than $80 billion in terms of capital expenditure on AI. We've got this big announcement coming from the likes of OpenAI, SoftBank, and indeed Oracle about the commitment to AI infrastructure. Here's Mark Zuckerberg saying, we're going to be having data centers the size of Manhattan, basically, that we're going to be building out, and that's going to cost money, up to $65 billion. Now, the market had thought he'd be spending about 52 billion, and some analysts, Bank of America, had seen about 58 billion in 2025. This is a marked uptick. And also, for someone who's trying to crimp down on less productive workers, remember, they're going to get tougher on who they're firing, letting go of, he does want to see more talent coming in the door. And again, it's about AI talent.
Yeah, there you have it. Caroline, great reporting, as always, both on American Express and Meta. I know you'll have much more on Bloomberg Technology. That is Bloomberg Tech co-host Caroline Hyde. And you can take a look at Meta shares right now. After that initial sticker shock of how much they're going to be spending, shares have actually turned around, now higher by about 0.8%, initially sinking about more than 1% when we got that headline. But investors looking into the details and maybe liking what they're seeing. Let's keep the conversation going now with Sarah Ketterer. She is Causeway Capital Management CEO. And Sarah, it's great to have you with us on this Friday. Let's start with CapEx. Of course, that big headline coming out from Meta. We know that American Express also has their own spending plans to try to get ahead on talent, on tech. As we head into the real heart of earnings season, how much of a microscope are you putting companies' CapEx spend plans under? Because you think about the tale of the past earnings season, especially with big tech, that ROI was a big question mark.
Yeah, I agree. It remains a question mark, and our Causeway analysts and portfolio managers are scrutinizing all this spend. Where we're particularly curious is what the enterprise applications would be for all of this AI effort. It's just very early days. But as you noted, the market's rewarding the spend. It's just sort of ironic, given these are supposed to be very cash flow generative businesses. But there are plenty of parts of the market that have been left behind in this AI frenzy, and I think that's of even greater interest to our team.
So where are those other areas? It's interesting today because you parse through the moves in the NASDAQ 100, and we know a day doesn't make a trend. But I was wondering, off the heels of Meta's news, how much you would see others rise. Broadcom is actually right now your biggest gainer in the NASDAQ 100. Raises the question, if you're going to capitalize on the AI boom at this point in time, do you buy the people that are investing in all that CapEx or the ones that are the recipients of it?
Well, in general, several of those stocks, you mentioned Broadcom, are at very high valuations. So if you are going to take an extremely optimistic view, they may be attractive. But there are lower risk ways, and this is what our team is particularly good at, of taking advantage of the technology without having to spend quite so much in terms of earnings and cash flow multiples. An example would be the power and industrial semiconductors, companies like Infineon or Renesas. They're very weak right now, but they too are going to be huge beneficiaries, not just of a renewed auto cycle, but of data centers, ultimately in robotics, automation.
Well, that's so interesting that you're specifically focused on auto suppliers here, and you see bright skies ahead for some of these companies that you name. The auto industry, there's a lot of concern right now when you think about tariffs on Canada, on Mexico. You think about how interconnected the North American auto industry is. When you're taking a look at all the up arrow factors for these stocks, how do you factor in possibly the threat of these tariffs?
Well, tariffs certainly loom large. About 15% of the autos that are bought in the U.S. are made in Mexico. So Mexico is important, but the automakers have other problems. They have margin compression. My colleague who covers autos for us at Causeway, Roth, tells me about the really difficult time these autos are going to continue to face because they have all kinds of cost increases and price discounting. But nonetheless, the content within each auto, as autos become more connected to the consumer, to each other, semiconductor content rises, as well as connector content. And that's what we find really interesting. The stocks like Aptiv, for example, very low, and yet their future is extremely bright. They're splitting out their wire harness, their electrical business from the more advanced, higher growth side of the company. So underneath the surface, if you look beyond this slump in autos, there's some very interesting trends happening. Electrification, EVs, and there are ways to take advantage of that at much lower price to earnings multiples and price to cash multiples than you're paying, for example, for some of the big AI winners.
I have a broader market question for you, Sarah, because if you look around, yes, we are finally having a market that has been back above its record highs, taking a breather today. But the breather that's been taken by this market has been weeks long. If you think about how long it's taken to get back over that 6,000 level for the S&P 500. So now that we're at these heights, what kind of attitude do you take to the market? Do you think that it's all rosy from here, or do you think that there's going to be some sort of pullback that would cause a better entry point to enter this market?
This is a very difficult question because overvaluation can last a long time. We've seen this many times in the past. And the point I'm making is lower risk by ensuring you have valuation support. It's at the heart of everything we do at Causeway, but it's really having that margin of safety, especially when the U.S. market is at this extremely high level relative to bond yields. U.S. market is looking extremely expensive. And that means it's an enormous market. So there's plenty for us to find. And again, whether it be in the power semiconductor area or in connectors, there are these fascinating companies that do benefit from the trends that are somewhat inevitable and yet trade at very low valuations. So we're taking those valuations and being very conservative, ensuring that we've got protection in the event the market does take a breather.
All right, Sarah, great to speak with you. That is Sarah Ketterer of Causeway Capital Management. Meanwhile, let's get back to some of these movers. It is a heavy earnings day, believe it or not, on this Friday. So let's take a look here at CSX. Shares falling on an earnings miss. The railroad is facing headwinds amid pressures from hurricanes and also that key bridge collapse. You can see shares currently down about 3%. Also, keep an eye on Boeing here. Had been lower pre-market, of course, after it came out with those surprise preliminary results and showed another quarter of losses, but shares recovering a little bit. You're also taking a look at Eli Lilly. I would show Novo Nordisk here because the news is that Novo Nordisk reported that its experimental shot delivered as much as 22% weight loss in an early stage trial. Novo shares absolutely soaring, up about 7.7% right now. Lilly initially had fallen in the pre-market on this news. These are the two companies in that race to develop a next-gen GLP-1 weight loss drug, and that race intensified this morning. But we should also talk about Meta, of course, that big headline that they're going to spend up to $65 billion on CapEx, about $15 billion more than analysts had anticipated. But Meta's shaking it off right now.
They're totally shaking it off, turning it around. If you look at the NASDAQ 100, which is down on the day, the top 5 gainers include Meta and also Broadcom. And if you pull up one of our favorite functions, SPLC on the Bloomberg terminal, you could see that supply chain. And you do have Meta representing 4% of Broadcom's revenue. So very interesting to see that move in synchrony.
Yeah, definitely. That $65 billion has to go somewhere. And it was a great question you asked Sarah about, do you invest in the company that's spending the money or the recipient of the money? And I'm sure for some investors, the answer is why not both?
I'm sure some people going way down the supply chain and figuring out the energy to providers to Broadcom to figure out that Meta investment. Anyways, a lot of things shaking up. We have more markets for you up next. Stick with us.
All right, welcome back to Bloomberg Open Interest. A quick check on the market. We're about 16 minutes into the session, and we do have some green to talk about. The S&P 500 up by about 0.1%. It's interesting to see the NASDAQ 100 lagging right now. You now have Meta shares higher, as well as Broadcom, as well as Apple, but still the benchmark overall unchanged. And then you take a look at the small caps, just can't get out of bed on this Friday. The Russell 2000 currently down by about 0.2%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Netflix getting raised to a buy over at Bernstein. The analyst cites increasing subscriber growth and increasing operational leverage, with the streaming giant reporting nearly 19 million new subscribers earlier this week. Next up, we have Guggenheim Securities upgrading Restaurant Brands International to a buy, saying that the stock's recent slump is overdone. The analyst says that management is making the right strategic moves. That's good for about 0.1% gain, 0.8%. Again, happy Friday. Finally, a different story over at Brinker International. That is the parent company of Chili's. It's getting a downgrade over at KeyBank Capital, with the firm cutting its rating from a buy, saying that the stock's valuation leaves little room for error and is well beyond a realistic bull case scenario. Harsh words translating into a 2.5% drop. This is Bloomberg.
It's time now for the Wall Street Beat. The hedge fund world will converge in Miami next week at Global Alts 2025. Bryan Corbett, president and CEO of the Managed Funds Association, joins us now from Washington. We'll be in Miami. I will be too. There are a lot of people headed down there, really from around the world. But I do want to start with where you expect a lot of the attention to be focused, because of course we are now past week 1 of the Trump administration.
Right.
You have put forward a lot of priorities when it comes to the acting SEC chair in the meantime. But if you had to kind of hone in right now, just to priority number 1, what is it?
Yeah, I think the priority is to really turn the page on the Gensler regime and move forward with policies that are focused on supporting our public and private markets. Let's reduce the red tape that's been put in place over the past few years. Let's stop regulating by enforcement. I'd say secondly, is embrace alternative asset managers as an important market participant that helps drive economic growth. And lastly would be to support pro-growth tax policies like preserving the current treatment of carried interest, which is important to innovation and financing small and medium-sized businesses.
You know, it's interesting. Some of the rules are already in place. Of course, there was a lot of rulemaking that happened under the former SEC chair, and you had really contested a lot of it. It got quite litigious.
Yes.
Are there some rules that you'll look to eliminate? I know that you're already asking to delay, for example, some of the compliance reporting deadlines that are associated with some of the more recent rules put forward. Would you look to get those completely eliminated instead?
So you're absolutely right. Under Chair Gensler, there were 20-plus rules targeting our industry. We sued on 3 of them. We won 2 lawsuits. So as we move forward, we are asking immediately for Acting Chair Mark Ueda to delay implementation of 2 of the more problematic rules. We're also asking him to withdraw an appeal. On the last day in office on Friday, Chair Gensler appealed a court case that we won. And we are asking the SEC to immediately withdraw that appeal.
Yeah, it seemed like it was a rush to the finish for the SEC last week. I want to talk a little bit more about these new rules, because one of the concerns that you express is that it could increase concentration risk in the hedge fund industry. But new rules aside, is that a concern for you anyway?
No, I think markets are competitive. There's new market entrants. One of the concerns we've had, frankly, with all of the Gensler regulation over the past few years is that it was such a heavy overhang on the industry that you actually saw the SEC causing concentration because of their rules. It was too costly, too expensive for new funds to launch. So as a result of what the SEC did, the big were getting bigger. So we think it's important to reduce that regulatory overhang and create, once again, a vibrant market system where you see a lot of new entrants and you see creativity in the markets.
Well, that's an interesting point to make, because then do you see new funds going to come to market this year at scale? We have already seen a lot of that last year, despite the regulations.
Yeah, I think so. It's a growing industry. You've seen alternative asset managers continue to be an important part of the portfolio mix for allocators, whether it's pension funds or endowments. So we think there will be continued investment appetite for supporting alternative investment funds, and we think you'll continue to see new launches as new investors come to market with interesting investment strategies and ideas.
Bryan, is there anything that you would applaud from the Gensler administration? I know that there was a lot that was really disputed, as we've been talking about, but what's going to stick?
Look, in terms of applauding, I think he took a very broad approach and really pushed industry out of the process. One of the things we are focusing on is not only let's go back and look at all of the rules that were passed and where we can make changes, but let's change the process. It doesn't have to be so adversarial. You saw Chair Gensler use regulation by enforcement as a tool to kind of find foot faults for companies and bring lots of enforcement actions. You also saw him push industry to the side when he was doing his rulemaking. He didn't look to consult before he proposed rules. He had his vision, he proposed it, and in many cases, he was taken to court and lost. So we think there's lots of things that can be done to change that adversarial relationship and create a more effective and efficient regulatory system.
Yeah, it seems like across industries, there's a lot of people that are happy to see Chair Gensler, of course, vacate the post there. But I want to move on from just the SEC. Let's talk a little bit about Congress, the new administration. What are your potential worries there? Obviously, there's a lot of opportunity that's been expressed, but what concerns might you have?
We look forward to working with the new administration, certainly with Secretary-designate Bessent, with Paul Atkins coming into the SEC. You see policymakers that have a lot of market experience. They have industry expertise, and they're focused on pro-growth economic policies. And we think that's really the important factor here. President Trump ran on and is looking to implement a pro-growth regime. As Congress moves ahead with tax policy, as I noted earlier, certainly making sure that we continue to focus on pro-growth tax policies will be an important part of our agenda.
You know, I think about the rules around short selling that we've seen in recent years as well, and then a number of short sellers shut down or reduce their activity. We only have a minute left here, but do you think some of that can come back to the market now that we have the potential in the new administration for a rollback of rules?
I do. I think short selling is an important strategy for investors. Many are looking to mitigate and offset risk, and they do that through short selling. Oftentimes, short sellers are the ones who detect fraud and inappropriate activity at companies as well. So we think it's an important tool. With some of the rules that are being sued and where there is litigation, like the short sale rule and the securities lending rule paired together, we're optimistic that you will see shorting remain an important strategy in the markets.
All right, Bryan, up against the clock. Got to leave it there. Great to speak with you. That is Bryan Corbett of the Managed Funds Association. Now, coming up in the next hour, Verizon CEO Hans Vestberg joins us. Don't miss that conversation. This is Bloomberg. All right, we are 30 minutes into this Friday trading day. Welcome To Bloomberg Open Interest, I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and coming up, the S&P 500 is headed for its best start for a new U.S. president since 1985, as Trump talks up growth policies and softens his tariff stance. And we're going to round out the earnings week with insight from the C-suite. Verizon CEO Hans Vestberg joins the show after reporting results that topped estimates. And Vanguard's S&P 500 fund is on the brink of becoming the world's largest ETF. We're going to take stock of VU's rising popularity. And Katie, we're looking at these markets.
We are looking at these markets, a close eye on that rally that we've seen in the first week of the Donald Trump administration. Building a little bit here. Of course, we hit that record high yesterday. We're technically at a record high rate now. All that matters is that we go up. The scale doesn't matter when we're at these levels. The S&P 500 higher by about 0.1%. The NASDAQ 100 finally paying attention to the rally underway that's going in Meta. The NASDAQ 100 up about 0.1% as well. The bond market still quiet. Of course, we are above 460 now, knocking on the door of 465 when it comes to that 10-year Treasury yield, but still pretty much unchanged on the day, Sonali.
It's interesting to have gone round robin. Want to also bring you some breaking news on home sales data. December existing home sales have risen to 4.25 million. The estimate was just 4.2, so we're pretty much in line with estimates here. Of course, those mortgage rates have remained high. It looks like some people might be getting used to it. Now we're going to switch back to these markets. Joining us now, Ann Berry, Threadneedle Ventures founder, and we're looking at Meta today. We have to. That estimate that they put out for how much they might spend on CapEx is going to set the tone for everything that we see next week in terms of big tech earnings. How did you feel about Mark Zuckerberg wanting to put another $65 billion on the table for CapEx this year?
Well, I think this is in keeping with the risk of not spending CapEx is less than the risk of actually going and spending more. But I think there's something that I'm worried about, the Sonali. It's not that it's setting the tone of the quantum of CapEx. It's the data that's missing around this that I fear is setting the tone for a bubble here. And this is what I mean by that. When you're in a board meeting, here's what usually happens when people talk about CapEx. The board will sit there and say, what is the return on investment, right? What is the yield that you're expecting from these dollars going into the floor? And I have yet to hear any of the big tech companies talk about what these dollar return on investments are going to be when we know they must be having these conversations, at least at the board level, and certainly going into the budget. So that's what I'm concerned about.
Well, you think about Meta in particular, and Mark Zuckerberg owns so much of the company. Yeah. That concern at the board level, specific to Meta, are you saying that it might not be addressed?
Well, I'd like to see the numbers, right? And it's not just there. We should see it at Alphabet. We should see it at a lot of these other companies where these CapEx numbers are huge. Now, I do think Alphabet, for example, does have a great track record in terms of capital allocation and capital discipline. And Ruth Porat does have a tendency to talk about return. We don't tend to hear this from Meta, and here's the cautionary tale. When all the spend was going into the metaverse, we also there did not hear what the return numbers were going to be. We heard descriptive, qualitative descriptions of features, but we didn't know what the return, what the dollar yield was going to be, and quite frankly, we haven't seen it. So that's my concern when it comes to Meta. And yes, maybe because you've got a controlling shareholder, you get that obfuscation.
Well, you have to wonder if some of the new board members care that much about CapEx as well. They like to be spending money.
Dana White is going to be asking all about this.
Hard to think
all
about.
Those tough questions.
Right. And so you think about what we might see next week. How do you prepare for it? Because we did have a market that finally hit past its record once again, but you are seeing some nervousness clearly still under the surface here. Do you think that investors will react like they have today to Meta's announcement if you do see the numbers and the ROI not proving what they're putting down?
I think that we'll see some of that. It depends on the sector, Sonali. So I think you're getting, and we're seeing it with Amex, right? It's down. It had actually a pretty strong quarter. I think the companies that are in tech that are given the benefit of the doubt, where the assumption is they know what they're doing with AI, will probably do well as long as they're seeing beats and optimistic forecasts in their earnings. For the non-AI, the non-pure play tech companies, I think it actually could be quite a punitive earnings season. I think that if you are seeing misses on costs like you're seeing at Amex, if you're seeing a lack of return, if you're seeing integrations not delivering, I think that's where it gets harder. And if you take a macro look at the equity market right now, the risk premium is zero, perhaps negative, which is just astonishing. So I think if we don't see the results in this earnings period, at some point this euphoria train we're on post-election, I think, runs out.
I'm glad you brought up the equity risk premium, because this is a question I've asked before, and it's how do you make a decision based on that? I know that, of course, in any reasonable portfolio allocation strategy, it's just one of several factors, but I mean, how do you actually factor it in? I assume you're not going to go from stocks to bonds just based on this measure.
No, and also because if you actually look at the risk premium, when you look at bonds also, they're very compressed, right? So actually finding risk-adjusted returns in either set of asset market is really difficult to find. So I think it's really looking for alpha. It's really looking for esoteric decisions around stock picks. I think it's gone beyond looking for industry themes. I think people are aggressively now looking to look at individual names in a way that they weren't doing over the last 2 years.
So let's recalibrate your top picks today.
Yeah.
Now that we know what we know now.
Yeah. So I've got two, and they're in completely different worlds. One is a theme that I've talked about on the show a lot, which is live entertainment and the hunger for it. Now, when I looked at Netflix come out, here's what was really profound: the impact of sports and the take-up and the impact of subscription. So I went from looking at Netflix, which I've been in for a long time and been a big fan of, and I've actually bought into TKO, which owns, back to what we were just talking about with Meta, UFC and WWE. UFC media rights are coming up at the end of this year, next year. I think there'll be outsized demand for it. I think they'll aggressively go into creative new leagues. I've invested in new sports leagues privately, and I think TKO's got some upside for that purpose.
That's really interesting, because when you say live entertainment, some people think of, concerts, actually going out and going to sporting events, but it sounds like a lot of this is tying into, actually just watching it on your TV.
I think it's both.
Yeah.
So I've also invested in the venues. We've talked about that before, but the fact that that is translating into demand, particularly amongst the streamers, for unscripted events where there's uncertainty, where there's fandom, right? It's the fandom and it's the repeat subscriber who comes back to be able to see their favorite teams playing or their favorite wrestlers dancing, choreographing, then I think that's the kind of thing that the streamers will go after and will spend money on, and TKO, I think, is well positioned.
I will say this. A year ago, I was not that excited to watch the Commanders clobber the Eagles, but this weekend I will be.
Oh my God.
I know.
Birds.
I can talk about football now.
I
don't know when that happened.
I have a lot of affection for Philly, so I don't know. But Ann, it's always great to see you. Have a great weekend when you get there. That, of course, is Ann Berry of Threadneedle Ventures. Now, coming up, speaking of earnings, Verizon posting a strong fourth quarter and shooting the stock higher. We'll speak to Hans Vestberg. He is Verizon chairman and CEO next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. President Trump softening his tone on tariffs against China, saying this on Fox News: "We have one very big power over China, and that's tariffs. I'd rather not have to use it, but it is a tremendous power over China." The yuan jumped against the dollar on the suggestion of a 10% tariff rather than the steeper 60% tariffs Trump previously mentioned. And JP Morgan CEO Jamie Dimon got a pay bump in 2024. Dimon earned $39 million in salary and performance-based compensation, up 8.3% compared to the year before. In the same year, JP Morgan beat its own record for the highest annual profit in the history of American banking. And Diageo, the company that owns Johnnie Walker and Guinness, is said to be reviewing its drinks portfolio to reignite growth. It is already looking to sell its vodka brand, Ciroc. According to people familiar with the matter, it's also studying the spin-off or sale of Guinness. And Tesla unveiled an update to its best-selling Model Y in the US and Europe in an effort to revive sales. The redesign borrows elements from the Cybertruck, including the full-width LED light bars, and also improved aerodynamics and better soundproofing. The EV maker looking for a turnaround after reporting its first annual sales decline, Katie, in over a decade.
I will say the Cybertruck looks awesome. That's my unbiased opinion. I don't know about that redesign. I don't really like the light strip, but again, Elon Musk didn't ask me. Let's talk about Verizon. A strong fourth quarter is powering Verizon right now. Shares higher to the tune of about 0.9%. The company reported numbers this morning that beat analyst estimates. Also saw strong gains in new mobile phone and broadband customers. Let's break it all down, the quarter that was and the future, with Hans Vestberg. He is Verizon chairman and CEO, joining us now. Hans, great to have you with us. Let's go to subscribers, because you reported a net gain of 568,000 monthly phone subscribers. The expectation had been for below 500,000. So from where you're sitting, where do you think that those gains are coming from?
So I think, first of all, we have a great offering. We had a very strong quarter, both financially and operationally. We added actually 1 million new postpaid customers on broadband and wireless together. And as you rightfully said, on the wireless side, 568,000. Very strong quarter. We have great offerings in the market. We have the best network that is supporting that. And we have gradually improved now over 5-6 quarters, sequential improvement, both operationally and financially. So we not only had a great operational quarter, but we also continue to expand our margins, and our cash flow for the full year was $19.8 billion. So very strong financials with a really solid growth on customers as well. So I think the products resonate with the market today more than ever. I mean, you cannot work, live, play without mobility and broadband. And I think we are meeting that as the largest carrier in the country.
You know, in addition to earnings, you also announced a new AI initiative as well. And how do you feel about the customers that you're bringing on when it comes to AI Connect? Because is this something that you believe will be a significant growth driver?
Yeah, definitely. But think about this. I mean, today, the majority of Gen AI is large language models being developed in enormous large data centers. When that's going to be applications for enterprises to use, they're going to go further out in the network, both for the transport cost, for privacy, security, latency. We have already those assets. We have compute, we have storage, we have cooling, we have power. We already have that in our system that we can host. And we already now have customers like Google, Meta, that is using our network for their AI work, you know. So this is just the start of it, and the second phase is going to be way out in the network. And then Verizon, which have fiber across the whole country, have also space and cooling, and as well as power. We have a lot of power that we can resell as well. So all that is creating a new business for us on existing assets that we don't need to develop. They're already there. So it's a great opportunity with the big announcements of Gen AI and data centers in the country, and US is the leader here and will be the winner on Gen AI. I think we're in a great position to be part of that.
Well, Hans, corporate spend is the theme of the morning, of course, with that big announcement from Meta. When it comes to this opportunity that you see in AI and your ambition to be the leader when it comes to Gen AI, how much are you willing to devote of CapEx to that goal?
So, as I said, the majority of what we have, we already have done it. We've already deployed one fiber strategy. So we have fiber going around across the country, close to data centers, close to all the enterprises. We already have space. We have capacity of power that we can reuse. So much what we have is already invested. So we think about the second part of Gen AI when the large language models are already developed, and you need to be closer to the user, the company, the enterprise, or whatever it might be. And they were well positioned. We already have revenues from it today. We had in the fourth quarter, even though we're small, we're now ramping that up. And that's why we announced today AI Connect, which is our product and solution for this.
I'm also just curious about regular way internet, because if you look at the internet subscribers that you brought on, the rise, or it was a decline from a year ago, but it was more than what analysts expected. And so what does that mean about the prospects of the people you are bringing on and what it means for the upcoming quarters?
So I think that our broadband strategy that we laid out in the third quarter is really resonating with the market. We have two great products. We have the fiber product called Fios, which is I would say, the highest quality fiber product in the market. We have great success with that. We added 50,000 new customers in the quarter. Then we have fixed wireless access, which is a totally different model where you self-install, you have great performance, high customer satisfaction. We added more than 300,000 370,000 of those in the quarter. So all that product is going into next year and or 25. We're already in next year to fortify that. And then we have our pending acquisition of Frontier that is adding even more fiber customers. So our broadband strategy is clear. We're taking share at the moment, and we think we can continue to do that into 25.
Let's talk about the share price a little bit, because I'm taking a look over the past 5 years, and I see Verizon shares down about 13% on a total return basis. Hopefully we'll have that chart up. And I want to ask Hans, I mean, what do you think that investors are missing when it comes to your story? And why are we seeing this sort of sideways chop when it comes to your shares?
I think if you look at our share price, I mean, it's always a lot of different combinations. I think we, of course, invested heavily in the 5G and in Spectrum, and we took on a lot of debt during the Spectrum acquisitions in 2019. Now we're working that down. We're almost down to our debt leverage of 2.25 on net debt to EBITDA. So we are actually paying that down. So I think that our capital allocation has been heavy to build our network, and now getting leverage on that. And that's what you see, and that's, I hope, what our shareholders will see, that growth trajectory can continue and we get leverage on it. Secondly, we are on the 18th year of increasing our dividend. I mean, there are not many companies that are doing that, and of course our yield is high today, given that the share price is a little bit subdued. But I think that's what our shareholders should see, and the prospect of shareholders, both that the dividend has been super stable and growing, and then now we also continue to grow both operationally and financially. So I have high ambitions here, and I hope that every stakeholder is going to see that.
Certainly, the debt load was something investors were keeping an eye on, and as you have made a lot of progress in terms of reducing that load, I do still wonder, you had come off an announcement of a massive acquisition. Do you see more potential acquisitions? If you're able to tap the capital markets or fund it otherwise, wondering what your inclination here is to do more to expand your reach through mergers and acquisitions.
So our strategy is pretty simple. We build one network, and we want as many profitable connections on top of it in any type of the segments of the market. Today, we are the number one on wireless. We have a nationwide, so we already have it. So now it's just to continue to get leverage on. On broadband, we just acquired or in the process of acquiring Frontier. We have a great broadband offering. We're planning to address 100 million households with our broadband offering. So I think we're sitting really good with assets we have, and that's what I want to execute on. As a CEO, you can never say you're never going to do an acquisition, but clearly we have all the assets right now, and now we are in execution mode, and see that we leverage that.
All right, Hans, really appreciate your time. That is Hans Vestberg of Verizon. Meanwhile, still ahead, we have another C-suite conversation. We'll discuss the live entertainment industry with J.W. Roth, the CEO of Venu. That conversation coming up next. This is Bloomberg. All right, welcome back to Open Interest. Let's get a quick check on these markets right now. Dipping lower on the big indexes right now. Of course, we got some economic data out at the top. We got those final January numbers coming in a decline for the first time in 6 months. You can see that sentiment trickling through right now. The S&P 500, the NASDAQ 100, now both lower on the day. And you can see the bond market finally waking up, finally reacting to something, but little moves overall. The 10-year Treasury yield now down about 1 basis point. 1 basis point, that is, singular there, because it's a quiet session overall.
It is a quiet session, but we have, as you've been talking about, have remained above 460 on the 10-year. For more, we are joined by Michael McKee, Bloomberg's chief international economics and policy correspondent. When you look at the health of the consumer right now, there are clearly so many fears about inflation expectations. When is this going to be a bigger deal? It seems like it's already starting to be.
It's starting to be, and the University of Michigan basically says this comes down to one person, Donald Trump. This survey went through Inauguration Day, and what it shows is people are afraid of two things: higher inflation brought on by tariffs, and the idea that maybe the labor market is softening and their job prospects won't be as good next year. They asked people about tariffs, and only 19% said they thought higher tariffs would be a good thing for the economy. 62% say they favor lower tariffs or no tariffs. So that's a big issue for people out there. The only thing that the Michigan people say kind of offsets this is that we have seen essentially strong consumer spending. So people are not acting on these issues yet, but it's something to keep an eye on.
When it comes to these surveys, do levels matter here? Because we're above 70, we're above where we were this time last year, even with this slight decline. I mean, how much should we read into this?
Well, you've got this survey and the Conference Board survey, which comes out next week, and they both use different scales. So the level doesn't matter so much as the direction and the speed of the move. And the fact that we've gone down for the first time in months says something about where people are. It looks like they're more nervous about the future than concerned to the point where they pull back, but they're keeping an eye on things. They're not maybe going to spend as much on big ticket items while they wait to see how all this works out.
How much is real and how much is rhetoric? I'm looking at, for example, Torsten Slok's note from this morning that charts these inflation expectations from the University of Michigan by political party. And what you see is the Democrat expectations have just soared for inflation, while Republican expectations have declined quite meaningfully. So what's real at the end?
Well, Americans are very bad at guessing what inflation is, although in recent years they hear the numbers all the time, so they're maybe a little bit more on top of this. But that's what always happens. Whenever there's a change of control in Washington, there's a change in the view of the economy. And in this case, today we see Republicans are much more optimistic about the economy. Democrats are much more pessimistic about the economy. But the interesting thing is that Republicans tend to answer the survey more, according to the University of Michigan. So they carry a little bit more weight. So the fact that we've seen inflation expectations in the next year rise, and they stayed at 3.3% in the final survey, does suggest people have inflation on the mind. Now, gas prices have gone up a little bit. So maybe that's part of it, but it's something to keep in mind.
We know a lot of investors watching it closely. RBC's Lori Calvasina have been saying that it's been high up in her investor presentations. Bloomberg's Michael McKee, we thank you so very much for joining us this morning. Coming up, we're going to talk about live events, talking about the consumer a little more, because Venu is looking to raise the bar. We're going to speak to the CEO of the company next. Stick with us. This is Bloomberg. Venu Holdings is looking to strike a chord with investors. The live entertainment company debuted on the New York Stock Exchange in late November. Venu now announcing a new expansion of its entertainment facilities over Texas and Oklahoma. Here with more, J.W. Roth, Venu Holdings CEO. When you think about these locations that you want to expand into, what are the number one things for each of these locations that really bought you there at the end of the day?
Well, ultimately, it's, there's a couple of things. There's first, it's demand, and it's the opportunities that provide itself in markets that are underserved by live entertainment. So that's number one. Number two, it's the public-private partnership, right? So we build our venues in partnership with municipalities across the country. And the municipalities that we have chosen fit a certain demographic, and it fits a routing schedule where we want to build our venues.
Well, talk to us a little bit about that demographic. Obviously, taking a look at some of the guitars that you have behind you and reading up on the country, it seems like country music is the name of the game. Give us a lay of the land and the opportunity set you see there.
The music industry is roaring, as you know. There's never been a time in history where ticket demand has been higher than it is right now for live music. And there's never been a time in history where the supply of new artists is higher than it is today. Live music is the number one leisure activity in the world. And so where we saw the opportunity was in the exchange, right? Where fans meet artists, and that's the venue. And so we set out to build premium venues. We just built what I believe is the most luxurious venue in the history of our country here in Colorado Springs, opened this last summer. We did a deal with the Ford Motor Company. Ford put their name on it. I think they paid the highest naming rights in outdoor live music, and it is by far one of the most premier venues ever built. And so we are doing that same exact thing in Broken Arrow, in the Tulsa market. McKinney in the Dallas-Fort Worth market, El Paso. We have 7 more that are under development right now. And so we're excited about changing the live music experience. Live music is about experience. It's about ambiance. And so we have just felt like the venues throughout the country are old. They're in disrepair. Just think about this. The average amphitheater is 40 years old. It was built back before rideshare, before elevated food and beverage. And so, we're changing what we believe the customer and the fan is demanding.
So I've actually specifically traveled to Tulsa for concerts before us on my 30th birthday, but the venue I was at didn't have fire pits. I want to talk a little bit of the video we just saw. When I walk into a venue, what can I expect?
You can expect over-the-top ambience and over-the-top experience. I've been a music fan my entire life, and so in my backyard, I built a big fire pit. And, I have a fire pit that can hold 50 people, and we have a bandstand in the backyard and so on and so forth. So when I decided to go build these, I decided to build them with the experience that people would enjoy as if they were watching a great concert in their backyard. So I sprinkle fire pits throughout my venue. I build clubs inside my venue. I partner with Troy Aikman of the Dallas Cowboys to build the Aikman clubs in Oklahoma and in Texas. But the video that you're watching right there is Colorado Springs. That's 92 fire pits that are sprinkled throughout the venue. It creates unbelievable ambiance. You have cocktail service, elevated food and beverage directly to your suite. My wife, she always complains when we go to venues. It's a long walk to the girls' bathroom. And then once you get there, there's a long line and all of these things. So I built it so that it would be like if you were having a concert in your backyard. The bathrooms are close, great food and beverage, great ambiance with a fire pit suite. And then in the summertime when it's hot, you don't want the fire on, then there's an insert that goes inside the fire pit suites full of ice and cold beer. Doesn't get any better than that.
I know. And the restaurant fees you get from food and beverage account for a lot of what you bring in the door. But the other part of that comes from ticketing. Something I'm wondering about is there's been a lot of frustration in this country in the way tickets are sold through the power of the big ticket providers. I mean, how do you view this issue as a large venue provider?
Yeah, it is an issue. It is an issue that is outside of the venue's control. So, the ticketing piece of the space is getting better. I think Ticketmaster is getting better. I think Access is getting better, and they are working diligently. I see what they're doing on the backside, and I think they're working diligently to bring more controls. In other words, the issue a lot of times in ticketing is the second sale, right? So it's the sale of the ticket. That's usually fairly smooth for the most part. It's then the secondary markets that create the havoc. And so we are watching processes come into place that is going to tighten that up. It is not something Venue controls, but it's something that Venue watches very closely.
I want to talk a little bit about your decision to IPO because, as I'm sure you know, there haven't been a lot of IPOs, especially of smaller companies, in recent years. So Venue, you have a market cap just below $400 million. You went public in November. Talk to me about the timing there and the decision to come into the public markets.
When I first started this business, some of my ideas were crazy because I wanted to build these over-the-top, luxurious premium venues. So I wasn't able to go raise capital. I had to finance it myself, which is what I did. But my hope and my goal from day one was to be fan-owned. Our company is obviously fan-founded because I'm a music nut. But I wanted to be fan-owned. And so the only way I could be fan-owned was to create a company that was publicly traded so that fans could actually own a piece of the music business. We're building the greatest collection of venues ever in history. And so I think there's a lot of people that want to be involved in that. When I went out to sell our fire pit suites, in a matter of 14 weeks, they sold almost $40 million worth of fire pit suites here in Colorado. And that told me that fans want to be involved in the experience. We sell $10 to $15 million worth of fire pit suites every single month. We'll sell over $200 million worth of fire pit suites this year. And that tells you that fans want to be involved in the space.
Well, JW, really enjoyed this conversation. Happy Friday to you. That is JW Roth, the CEO of Venu. Meanwhile, let's get a check on these markets. About an hour into the trading session, we're a little bit lower on the day on what's been a very good week. The S&P 500 currently off by about 0.1% if you round up or down, whatever you want to call it. The Nasdaq 100 also lower on the day, even though you do have this rise in Meta shares and some of the other tech names. Let's get into it now with Bloomberg's Bailey Lipschultz, and I feel like we have to start with Meta.
You have to, and when the company unveils that they're going to spend $65 billion in 2025, primarily around AI infrastructure. This comes on the back of that big Stargate announcement that sent shares of Oracle soaring. We are seeing Meta outperforming up about 1%. It is the best performer so far this year. The year is young, but the best performer among the Magnificent Seven stocks. I find it interesting, Katie, that just back in 2023, Mark Zuckerberg coined it the year of efficiency, and now it seems like 2025 more than happy to open the checkbook and really invest in AI, which has been the topic of 2024. So you are seeing shares again up about 1% and kind of really one of the outperformers among big tech.
What can you say? Things change.
Yeah.
Also, we're looking at Texas Instruments as well. Another chip story there.
Yeah, chip story on the downside, though. This is coming after their outlook for 1Q fell short of what analysts were looking for. A company still working through some of those backlog issues. And really, when you just look at what management was talking about, really trying to kind of right the ship, if you will, in terms of their focus. Again, this is a company that doesn't sell those AI chips. So this isn't a NVIDIA play per se, or even an Intel in terms of the price and some of the margins on some of those products. But when you have results that kind of fall short of what expectations were, when you're talking down the quarter ahead, really the first big chip reporter here in the U.S., that's going to happen. And we can, again, see the stock down 5.5%, weighing on analog devices, NXP Semi, on semiconductors. A number of the group really under pressure this morning after a lackluster forward view.
Any commentary on the calculators? No?
I haven't used one since high school.
Yeah.
I don't know if I had one in college. Probably.
The terminal has a decent one.
That's true. That's true. I wouldn't know how to use it anyway. I mean, in any case, let's talk about Eli Lilly and Novo Nordisk. I do know some math. Big news out of Novo Nordisk today. They needed some of the enthusiasm that we've seen over in Eli Lilly, getting it with these trial results.
Early stage results showing that they could deliver as much as 22% weight loss in that early stage trial. As you mentioned, this really has been a tale of two stocks over the last year in a race for the next generation of weight loss drugs. The big thing to keep in mind, though, while the stock is up, at least the ADRs are up more than 7%, on a 12-month basis, down 16%. That compares to Eli Lilly, which is up 23%. So you are continuing to see kind of moving across the spectrum in terms of investors positioning for who is going to actually really win. And again, this is a stock that's down 41% from its June highs last year. So really a small win for today, but the big question going forward is, can you continue to come up with better drugs, better shots, if not oral medicines, and can you get patients to stick on those? That was the big issue with their earlier data that sent shares lower last year, was people not being able to stay on the medication, which is kind of the whole point.
Bailey, real quick here. I'm really curious to hear a little bit more about your reporting. We're almost a month into the year. We haven't seen very many big IPOs, as everybody has been talking about. When you talk to capital markets desks, what are they really preparing for? Is it really going to be as rosy as people are saying out there?
Wait and see. We did see Venture Global raise about $1.75 billion last night. They are getting their indications. They're in the LNG exporting space, so not really a Klarna or a Chime, which everyone's excited about. But it does seem like we're going to see some real activity in that March to May timeframe with Chime, Klarna, CoreWeave in the AI space. But the big question still is, who else is going to go? And if you can go out and raise tons of money in the private markets, what's the incentive to go public? So cautious optimism, but that's kind of the topic of banking.
Not so surprising to see an energy one hit the filings right now. Thanks so much for your time, Bailey. Of course, that is Bailey Lipschultz of Bloomberg News. Now coming up, and I'm just learning this saying, fewer people are hitting the hooch, and it's changing the booze business. Yes, we're talking about alcohol. In this week's Wall Street Week, David Weston explores the rise of the sober curious movement and how it's raising the bar for non-alcoholic beverages. This is Bloomberg.
It's time for our daily Wall Street Week conversation, and it's nearly the end of dry January, where people ditch alcohol as part of their New Year's resolution. And the sober drumbeat has been getting louder as the U.S. Surgeon General recently called on Congress to require health warning labels to inform consumers about the link between alcohol consumption and cancer risk. David Weston spoke to attorney Brad Berkman, as well as Athletic Brewing's Bill Schulfed, about the non-alcoholic beverage trend.
People drink in good times and people drink in bad times. Well, the trends appear to be disproving that.
Brad Berkman's family has been in the alcohol business since his great-grandmother became one of the first women to hold a New York State liquor license. Now he's a lawyer at Green Spoon Marder, representing breweries, wineries, and distilleries.
There's a lot of concern with sales volume. 2024, as we move into 2025, we've seen significant drops in all categories of alcoholic beverages. That is wine, beer, and distilled spirits. And the industry is a bit rattled by it.
And it's young people driving the change. In a survey last year, IWSR found that the number of U.S. drinkers who had added non-alcoholic beverages to their mix had gone up from 7% to 13%. For millennials, it was 22%, with Gen Z following at 15%.
I mean, boomers are still drinking, right? We're not seeing that much of a difference in all categories. But Gen Zs, as I mentioned, are looking for health alternatives, or healthier alternatives, at least those things they perceive to be healthier. So, what does that mean? It could mean non-alcoholic alternatives. It could mean low-proof drinks, low-proof spirits. It could mean seltzers or similar products.
While bar and restaurant volume is an overall low percentage of our volume, I think it's a really high introduction to our product.
One of those making the change from alcoholic to non-alcoholic beers was a young trader at Point 72 named Bill Schufelt.
I was turning 30, taking my career more seriously. I was about to get married and kind of evaluating all these major goals in my life, like health, wellness, relationships, career, being a father. And there's one thing that was a ceiling on all those things, and that was alcohol. And I kind of realized, I'm going out to 3 or 4 work dinners a week, then social things, dinner with my wife, and relaxing on weekends. And I went from someone who was surviving workouts to loving working out. And so basically feeling the best I'd ever felt and being as productive as ever. But I was still at all those social things. And I realized there was no other half of the adult beverage menu. So if you wanted to be in all those places and not drink, there weren't options.
So Schufelt teamed with craft brewer John Walker to create some of those non-alcoholic options, founding Athletic Brewing in 2017.
That was Brad Berkman and Bill Schufelt. You can catch Wall Street Week tonight at 6 p.m. Eastern. This is Bloomberg. Well, Vanguard is on the brink of dethroning State Street for the crown of world's biggest ETF. It's a much coveted title. Let's break it down now with James Seyfert of Bloomberg Intelligence. And James, we'll start with the numbers. Nearly $18 billion has flowed into Vanguard's S&P 500 ETF so far this year. For context, that is more than 5 times the amount of its closest runner-up. And that's after it took in $116 billion last year, which was an annual record, and then some. What is going on here? Who are these investors who are piling into VU?
I mean, the other thing I would say is the next closest competitor, I think, is there another Vanguard
That's true,
ETF.
actually.
It's the Vanguard Total Stock Market ETF. So, I mean, Vanguard is having a pretty hot start to the year, but they always do. I mean, they take in billions of dollars per day across their ETFs and mutual funds. I mean, it's an absolute machine over there. I think a lot of it, Vanguard has really kind of owned the retail space, the do-it-yourself investors that buy and hold long-term passive index investors. That's kind of what Vanguard is known for, and those investors are pouring their money into their ETFs, even more so than their index mutual funds nowadays. So I think that's most of it, but also advisors like them too. Advisors are using their products, they're low cost. It's a kind of a diverse mix, but I think they really have won the retail investor audience.
The retail investors, is that what's helping them at the end of the day when it comes to the most close rival product? Why is it that you have the Spider SPF, S&P 500 ETF lagging behind it at this juncture?
Yeah, I mean, SPY is the most liquid instrument on the planet. I mean, even just looking at the shares that it trades. But if you take into account the options that are traded around it and things that are linked to SPY, it's not even close. Like, so liquidity-wise, you would still go SPY. But assets-wise, VU, that's a little bit easier to, take market share from. And if you compare it to the iShares product, IVV, we kind of see that as sitting in the middle between SPY, which is like almost completely institutions, and VU, which is largely retail. IVV kind of sits in the middle, and it's also likely to dethrone SPY potentially this year as well. It's not that far behind VU. And honestly, I wouldn't be surprised if BlackRock cuts the fee potentially to kind of, catch up to VU as it's running away here.
Yeah, Todd Rosenbluth told me the same thing when it comes to IVV fees. So to put it all together, it sounds like Vanguard, VU, of course, they have the retail crowd, the buy and hold. You think about SPY over at State Street, of course, that thing is loved among professional traders. It trades like water, super thin spreads here. Let's talk about when we actually see the flippening, if you will, because VU currently stands at about $626 billion in total assets. You have SPY at $637 billion. When does VU finally steal the throne?
Yeah, who knows, right? It's the market that's going to determine this. There's been a lot of flows that come in. I mean, we're talking about a $9 billion difference, and I guess on a percentage basis, it's like 1% or so, but that's still $9 billion. But what I will say is one of the benefits of VU is it doesn't really have that much in the way of significant outflows. Whereas something like SPY, it can have massive inflows, but also massive outflows. So if we see a downturn in the next week or two, it's likely that way more money is going to come out of SPY than is going to come out of VU, because the people that tend to hold VU tend to be more, use the term diamond hands. They tend to hold on to their things a lot longer. They're not really going to be soft hands and sell rather quickly. So if we see a downturn, it could happen really quick, but it's likely to happen in the very near term.
Okay, so we're talking about King of the Castle Vanguard here, but Katie points out to me that they don't really touch crypto.
It'll be a cold day in hell when that happens.
And so if we're thinking about that juncture right now, we talked so much earlier this week. Katie and I are laughing. BlackRock's Larry Fink talking about the promise of cryptocurrencies, obviously capitalizing a lot on those Bitcoin flows. And now elsewhere, you see a rush of flows and other filings. What are you expecting? Because, of course, all of these other tokens are far from being Bitcoin.
Yeah, I mean, as far as Vanguard goes, they don't even have gold ETFs, but what they do is on their platform, they allow you to invest in gold ETFs. So I think they made a mistake personally in not allowing anyone to even make their own decisions on their platform to own some of these products that are already out there, Bitcoin and Ethereum. I mean, honestly, the government has kind of shifted past. I mean, we've gone from massive headwinds to the crypto space to now seeing tailwinds. I mean, this week has been an absolute whirlwind. There's been some pros and cons depending on how you look at it. So I don't know. Salim Ramji is now running the ship over here at Vanguard, and I wouldn't be surprised if they, kind of undo potentially what they've done in basically blacklisting anything related to crypto from their platform. I also do not think under any circumstances Vanguard is going to launch a crypto ETF anytime remotely soon. So allow people to invest in these types of products, yes. Launch a product, no.
Yeah, it's a good point on Ramji, of course. He was behind the push over at BlackRock when it comes to Bitcoin, but definitely a little bit of culture shock that would await him at Vanguard if I think he tried that right now. But James, it's great to speak with you. Have a great weekend. That is James Seyffert of Bloomberg Intelligence. Make sure to tune into ETF IQ every Monday at 12 p.m. Eastern. And great news, you can read all about the ETF industry in my weekly newsletter, also called ETF IQ. That is Bloomberg.com/ETF IQ. Newsletter. Let's get a quick check on these markets, of course. It's a pretty soggy end to what's been a very strong week. The S&P 500, the NASDAQ 100 a little bit lower on the session. A rally building in the bond market. We're still above 460 for now, but currently the 10-year Treasury yield down about 4 basis points. And as we look ahead to next week, Sonali, let's talk about schedules, because you're off and then I'm off. Where are you going?
I'm going to Miami. I'm going to go down to see what the hedge funds are up to. I'm going to be speaking with Stephen Ross, of course, of related fame, talking about what he's seeing. Is higher for longer all that bad? Where are you heading?
I'm going to New Orleans, and not for work. I don't think I'll run into any billionaires, but you never know. In any case, have a great weekend when you get there. Thanks for tuning in to Bloomberg Open Interest. Much more markets coverage ahead. This is Bloomberg.